Welcome back to Critical Accounting. My name is Cameron Graham, Professor of Accounting at the Schulich School of Business. Today we're going to talk about inventory. We're going to look at some basic definitions about inventory, and then we're going to consider how it's measured in terms of its value on the balance sheet, cost flows, how inventory flows through the company, the kinds of things that are done to control inventory, and then we're going to look at an interesting example of how to manipulate earnings using inventory. Inventory is defined in IFRS under IAS 2, and the three categories of things that it covers are assets that are held for sale in the ordinary course of business. So this would be finished inventory items. It does not include assets that are held for sale that aren't in the ordinary course of business. So for instance, a company that has decided to sell a factory or sell one of its delivery trucks. These are not the goods that it sells in the normal course of business. So although they're held for sale, they're not considered inventory. IAS 2 also defines inventory to include assets that are in the process of production. So these are partially assembled inventory items. And then the final category would be consumable materials and supplies. So, the raw materials that go into the products, the screws and glue and so forth that are used to assemble those products. That's all considered inventory. What's not covered is basically stuff that's quasi-inventory, but is covered elsewhere. For instance, work in progress is covered under IAS 15. So if you're a construction company, the building that you are creating is going to be billed out to the client on perhaps a floor-by-floor basis as you make progress, but is not considered inventory under IAS 2. It's covered under IAS 15 as part of the contracts with the customer. Same goes for consulting firms that may have some outlays in terms of wages and so forth, employee expenses as they're working on a consulting gig, and they're not ready to bill that to the customer yet. So the costs associated with that get capitalized as assets that will be offset against the revenue, but they're not, strictly speaking, inventory as far as IAS 2 is concerned. It's all covered under IAS 15. Financial instruments that are held for sale are covered under IAS 39. There's technicalities there that have nothing to do with the way that inventory is costed and measured. Agricultural and forest products are covered under IAS 41. And I think one of the key distinctions there is things like, if you've got an apple orchard, what does your inventory consist of? It does not consist of your apple trees. It does not consist of the plants that you're going to continue to hold into the next season. And also the actual apples and so forth that you harvest off of those trees are treated differently than inventory is under IAS 2, potentially because a lot of those things that are grown in agriculture are already sold under forward contracts. The same thing goes for commodities. Commodities that are held for sale, such as oil, gasoline, gold, those sorts of things that a company might hold as what you might consider its inventory, they're not covered under IAS 2 because those always have to be measured at net realizable value. And we're going to see how inventory is costed under IAS 2. It's not simply net realizable value. The reason that net realizable value is applied to commodities is because you've got a spot market that you can turn to get the exact value of your inventory at any time. As long as you know the quantity, you can look up the price on the market, and there's no issues related to the kinds of things that IAS 2 covers. Now that we know what goes into inventory, what counts as inventory, the question is, how do you measure its value? Inventory is measured at the lower of cost or net realizable value. Under IFRS, there's a whole bunch of things that you can include as the cost of your inventory, and we'll cover those in a second. And whatever those add up to, that is the cost of your inventory, and that is what you should show on the balance sheet. The problem is, of course, is if something happens afterwards that has made you realize that you're never going to get for your inventory more than it cost you, you should reduce the amount that's shown on your balance sheet down to what's called net realizable value. So suppose that it costs you $1,000 per item to acquire your inventory and get it ready for sale. And now you find out that the units that you expected to sell for $1,200 each, the price of those has gone down in the selling market down to $800. You can't show the inventory at $1,000 a piece. You have to show it at $800 because that's the price you're going to get for it. That's your net realizable value. And if there are other disposal costs involved with that, then that should be deducted from the net realizable value as well. The other possibility, of course, is that after you've built your inventory and got it ready for sale, something might have happened, such as a fire or a flood, to damage it, and you know that you can't sell them for the regular price. So that would also lower the net realizable value of the inventory. So to be conservative, you have to show your inventory on the balance sheet at the lower of its cost to you or the net realizable value. So what's included in the cost? The cost includes three items under IFRS: the cost of purchase, the cost of conversion, and a general category of other costs. So the cost of purchase, and here I'm going to pop up a whole bunch of text. This is for reference purposes. It includes, of course, the purchase price that you paid for it, but also any duties or taxes that you're not going to get reimbursed for. So sometimes when you import things, the government might give you a reimbursement for your duties, or it might give you tax incentives for a certain kind of inventory because it's trying to stimulate that part of the economy. Anything that's recoverable should not be included in the inventory price. That would be another asset on your balance sheet that you would eventually get reimbursed for, but it wouldn't be inventory. Any other direct acquisition costs, such as shipping and handling, need to be included in the cost of purchasing the inventory. And you are supposed to deduct from it any discounts or rebates that you are going to be getting back from the vendor. If you bought a large quantity, you may get a discount or a rebate on your purchases from the vendor. The cost of conversion is basically work in process. So if it's a manufacturing facility, then you are going to be actually taking components or raw materials and assembling them into units that will be available for sale. And there's three different categories here. There's direct labor, fixed production overhead, and variable production overhead. And I've listed some examples of those there. The important thing to note here is that it's not simply the direct labor that goes into it or the materials and so forth that go into the assembly of an individual unit of inventory. You're also supposed to allocate to inventory on some sort of systematic basis the fixed production costs. So, for example, the depreciation on your factory, the maintenance of your machinery that is used to produce the inventory, all of your factory management and admin. So, not your head office staff, but anybody who's directly involved in running the factory. Those are all fixed costs that don't change with the amount of inventory that you produce, but you're still supposed to allocate those to the cost of inventory. And then the other category, other costs, is basically everything else that's related to getting the inventory ready to sell. But there are specific things that are excluded. So wastage. If you built some inventory items and they didn't work out and you had to throw them out, that does not get included in cost of inventory. That's wastage. The storage of finished goods. Once the inventory is ready for sale, the cost of warehousing it in the area where you're going to be selling it is not considered part of the inventory cost. That's a carrying cost of the inventory. Administrative costs that are unrelated to inventory, such as what I mentioned earlier, head office, salaries, and so forth, should not be included in inventory costs because they have nothing directly to do with inventory. And also anything to do with selling costs, so marketing and logistics and so forth. Those kinds of things that are the cost of getting the goods to the customer once it's ready for sale. Those are not inventory costs per se, they're selling costs. So that slide there allows you to consider all the different components that are involved in inventory. And you can see under IFRS, it's pretty detailed. In order to understand that previous slide better, it's really important to consider what is not covered in there. So the three categories of operating costs that are not covered and not included in inventory are selling, general, and administrative costs, SG&A. I've got them listed here in a different order, but let's go through them. Your selling costs include all your distribution costs, so logistics, as I mentioned earlier, but also the cost of insuring the inventory when it's sitting there ready for sale. Marketing costs like advertising costs, the website for people to come and order stuff, any social media work that you do that you pay people to do. All those marketing costs are not part of inventory; they are selling costs. And of course, any salespeople that you've got, the wages they pay to them, commissions, their travel expenses, all of that is a selling cost. It does not get lumped in with the cost of inventory. Administration costs. So this is your head office, the wages, salaries, and benefits that are paid to them. Anybody that's not related to sales, that's an administrative cost. And general would be everything else. So rent on your head office, electricity for your head office, postage, supplies, computers, and so forth that are not related to the actual production of inventory. All of that stuff is a general operating expense. All of these things are related to the operations of the company, but not related to inventory, and therefore they're expensed as they're incurred, perhaps on a period basis, and they are not capitalized as inventory and meted out to the income statement along with the cost of goods sold. They go directly into their own categories under operating expenses on the income statement. Inventory cost flows have to do with understanding how inventory flows through the company and how you track the costs from entrance of the goods into inventory to their exit as cost of goods sold. IAS 2 specifies three different ways of doing this. The first is specific identification. So anything that's got a barcode on it, if you're an electronics company, an electronics store, and you're ordering goods from your manufacturers and your wholesalers, each of those units would have a separate barcode on it, and you would be able to track exactly which item came into inventory, what it costs you, and then when you sell it, you'd be able to identify which unit sold and what its cost was at that point. There's no argument about what the cost of goods sold is in those cases. But when you don't have the ability to specifically identify your inventory items, you have to make some assumptions about it. And there's two possible assumptions. One is what's called FIFO, first in, first out. And this is the assumption that when you sell a unit, it probably was the oldest one that you had in inventory. And that may or may not be exactly what happened physically, but it is certainly a reasonable assumption when inventory comes in and you sell the older stuff first and to sell the newer stuff last. If you do this, then you're going to be able to assume that the cost that's associated with any units that you're selling pertain to the oldest purchases in your purchase history, and what's left over in inventory at the end of the year is going to be the stuff that was bought under the latest prices. Now, obviously, this only makes a difference if prices are rising or falling. If they're stable, it's not going to make any difference. And we'll see some examples of that in a minute. Weighted average cost is a method of basically lumping everything into one big pile and not caring which units you sell. Obviously, physically, this makes sense if you're selling a bunch of nails. You buy some new nails, you dump them in the bin. Customer comes along, grabs a bag of nails. You don't care which nails they got. If you're going to do inventory like this, it doesn't have to be stuff that physically behaves like that, but you can make an assumption that it does. And the way to calculate inventory costs is to add up the total cost of the inventory, everything that was there at the beginning of the period, plus all the purchases, and then divide by the total number of units. That gives you your average cost of the inventory for the year. And then you can calculate how many units were sold, and you'll know what the average cost of those units was for cost of goods sold, and you'll know what the average cost of the units is that are left over in inventory. Now, you can do this two different ways. One is to calculate it at the end of every accounting period, and the other would be to update the average cost every time you receive a shipment of goods because you know what the price was at that point. Either way, you're able to calculate the average cost of the units that are sold in between shipments arriving. And that way you can calculate cost of goods sold and the ending inventory value. So these cost flows are sometimes necessitated because IAS 2 requires you to use specific identification when you can. And in the other two cases, these are ways of measuring inventory costs and cost of goods sold based on certain assumptions that you have to make about what's actually happening in the company. Just a note about LIFO, which stands for last in, first out. This is a costing method allowed under GAAP, the accounting regulations that pertain in the USA. In a nutshell, it's FIFO, but backwards. IFRS does not permit LIFO to be used, presumably because companies using LIFO can fairly easily manipulate their cost of goods sold, and therefore their profits, simply by not reordering stock. Allowing inventory levels to drop would trigger the sale of old inventory, which, if costs have been rising over time as they usually do, would have been purchased at a lower cost. Selling those old units instead of newer, more costly units would generate higher profits that are purely driven by the company's accounting choices, not its financial performance. International accounting regulators love to think that accounting measures something real. All right, so here's an example of weighted average cost versus FIFO, the methods that you would use when you are trying to make assumptions about how goods are flowing through the company. And here we have four different purchases. So the bars in the bar graph correspond to the price at the point in time at which you made those purchases. And for simplicity's sake, we're assuming that we purchased 1,000 units each time. The first time we purchased units was at $21 a piece. The second time was at $24 a piece. The third time at, what's that, $33 a piece. And the fourth purchase was at $46 a piece. So prices are rising. What is the impact of using weighted average cost versus FIFO? Let's calculate average cost first. So the average cost is going to be calculated by adding up the total costs there. So 1,000 times 21 plus 1,000 times 24 plus 1,000 times 33 plus 1,000 times 46 divided by the total number of units, which is 4,000, will give you a price of $31 per unit. That's on average. And so your cost of goods sold, on the assumption that you've sold 2,500 units during the period in question here, would give you 2,500 times $31 gives you 77,500. And your ending inventory of 1,500 times 31 would be valued at 45,500. Now, if you wanted to do this on a first in, first out basis, the calculation is going to be a little bit different. So let's look at that. So the assumption here with first in, first out is that the units that you sold, the 2,500 units, came from the first couple of purchases and then part of the third purchase. And then what's left over in inventory is the 500 units from purchase number 3 and all of purchase number 4. Now, as I said, this doesn't have to be physically exactly what happened, but you can assume that this is what's going to happen and do your costing this way. What does the calculation look like in this case? Under FIFO, the cost of goods sold is going to be 1,000 times 21, that's the first purchase, plus 1,000 times 24, plus 500, that's half of purchase number 3, times the unit price of purchase number 3 of $33, gives us a calculated cost of goods sold of 61,500. And the ending inventory is going to be the remaining half of purchase 3 and all of purchase 4, which is a value of 62,500. We're going to do an exercise in class where we can work out these calculations in more detail. But you can see that this does make a difference in this case because prices are rising very dramatically during this accounting period. If the prices were much more stable, then the difference wouldn't be anything as dramatic as this. But you can see that what's going to happen is it's going to have a big impact on your income statement because the cost of goods sold is going to be different. That's going to change your gross margin and your profit margin. And it's also going to have a big impact on your current assets because the ending inventory value is going to be different. So that's going to affect all of your different ratios and stuff that you do when you're doing financial statement analysis. Here's two different ways of doing inventory control. The basic idea of inventory control is how do you make sure that what you purchased is still in the warehouse and it's going out the door to customers and not somewhere else? So the periodic system on the left-hand side there is the one that is used when you don't have sophisticated computer systems. A small store might use this. Of course, you know that point-of-sale systems are becoming extraordinarily cheap, so anybody with an iPad can have a point-of-sale system running on their counter. But for the sake of humoring the textbook author, let's talk about periodic inventory control. In that case, you know what the opening inventory is from your balance sheet. You keep track of all the purchases during the year, and the total of those gives you the cost of goods available for sale. The next thing you do is you do a count at the end of the year, the end of the accounting period, to determine the inventory and the difference between all the goods that were available for sale and your ending inventory must be the cost of goods sold. Under the perpetual system, the first three steps are the same. You've got your opening inventory, you've got all your purchases, you know the cost of goods available for sale. But you deduct from that the cost of goods sold at the point of sale. So as you go about selling stuff, you record the sale and the cost of goods sold at that moment in time. And at the end of the period, you should know what your expected ending inventory is. Then when you do your inventory count, you can tell the difference between what you expected to have and what you ended up with. And that's what's called shrinkage or leakage. And that could be because stuff went wandering out the warehouse door in one way or another. There could have been theft by employees. It could have been theft by customers. It could have been theft by anybody else. It could have been just mishandling of some of the inventory purchases, whatever. But this is the only way that you can actually tell what the shrinkage amount would be. Under the periodic system, you can't tell. So perpetual inventory is very useful for inventory control, but it's a little bit more work and sometimes involves an expensive computer system. It's interesting here because there are some issues here related to the assumptions of the textbook author, I think, about what the purpose of a company is and what its relationship is with its employees. In class, we're going to be doing some thinking about this. What are the alternatives to the assumption that shrinkage was because of your employees stealing stuff that seems to presume an adversarial relationship with your employees? So let's think about that a little more deeply in class. Here are the two key points I just want to highlight here. In the periodic system, the key point is when you do your ending inventory count. And in the perpetual system, the key point is right at the moment of sale. Your point of sale system will record the inventory going out the door. And that's really the key difference between the two. So far in this course, we've talked about earnings management as something that is done through estimates provided by management to the auditors and embedded in the financial statement calculations. This includes things like the allowance for doubtful accounts for accounts receivable and, say, the valuation allowance for tax assets. Those are estimates that management has to come up with and justify to the auditors, but they are all estimates of what might happen in the future. Inventory can be used to manipulate earnings quite directly. And an example of an industry that's affected by this is the auto industry. So let's look at how it's done. The example on the left is a steady state schematic of what a company might go through, starting with 50,000 units of inventory and then adding 400,000 units, selling 400,000 units, ending up with a new closing balance, and then the same thing the following year and the following year, everything very steady state. And in this case, the price that the company is expecting to get per unit is 100. The $100 the company is going to make per unit when it sells it is going to be based on the units sold, and that will give you a revenue of 40 million, right? 400,000 times $100 per unit. On the other hand, the costs involved with this come from, first of all, the number of units sold times a unit cost. And what's the unit cost going to be? It's going to be the variable cost, so $40 per unit, plus an allocation of the $8 million in fixed costs. So remember, the fixed costs had to do with things like the depreciation of the factory manager, as opposed to the variable costs that included the direct labor in building units and the consumables and the salaries of shift supervisors and so forth that vary with the amount of production. If you take that $8 million of fixed costs and you divide it by the 400,000 units, you end up with $20 per unit. Your total cost then is the $40 plus the $20 for a $60 cost per unit. And that times the 400,000 units gives you a cost of goods sold of 24 million, and your gross margin is 16. And so that is going to be the steady state across all of those years. And you also end up with a very clear opening inventory and closing inventory that doesn't change because nothing has changed on the costs or anything else. So what happens then when management decides to manipulate the earnings of the company by overproducing? So let's just assume that nothing is going to change in relation to the costs of the inventory. Nothing is going to change in terms of the price that the company can get for it. Let's see what happens when the company overproduces. Here is the overproduction highlighted right there for you. So all that happened was in 2021, the company decided to produce 40,000 more units than it needed. And you can see it's compensated for the following year by producing 360,000. So the total amount produced over the 3-year cycle is the same. What's the roll-on effect of this? For starters, the number of units in the closing inventory is going to be a lot higher because you produced 40,000 more units and you only sold the same amount as you had previously planned. So you end up with 90,000 units. You also have this really curious thing happening here. So you've still got the same 8 million in fixed costs, but it's now divided by 440,000 units rather than 400,000. So the fixed cost that gets allocated to each unit is now only $18 instead of 20, making the unit cost $58 instead of 60. What does this mean? It means that your cost of goods sold is lower. The same amount of units sold are now being sold at a lower cost of goods sold because the fixed cost has been amortized over a larger number of units produced. So this then increases your gross margin, and presumably that $636,000 bump there gets translated down to the bottom line of the income statement. And you can see what happens here is you end up with a change in your closing inventory as well. And what does this mean? It means that you've got an increase in gross margin, an increase in profit margin, and an increase in the value of your inventory asset. Now, presumably, you had to part with some cash in order to accomplish this. So you may well have no change in the total current assets, but this is not going to have any effect on the current ratio. It's going to have a nice effect on your profit margin and your profitability ratios. The only thing that it's going to affect in terms of your liquidity analysis is that the quick ratio is going to be different, because if the cash has gone down and inventory has gone up for the cost of the extra 40,000 units, then you can have a slight shift from quick assets to the other current assets that are not quick. And otherwise, this is a very simple, straightforward way for the managers to decrease their fixed costs on a per unit basis and decrease their cost of goods sold and increase their closing inventory. All of it perfectly legal. The only downside to this is that the managers have to somehow make up for it the following year, and they pay a penalty with an increase of their cost of goods sold there and a decrease of their inventory from the previous year there. If the managers were planning on retiring in 2022, they don't care. So this is something to keep in mind. There are real ways for managers to manipulate the earnings, and when you see changes in inventory values, you need to ask yourself what's going on. So let's summarize. We have covered the question of what counts as inventory, includes everything that's held for sale, everything that's still in production, and all the consumables. We talked about inventory measurement. The cost of the inventory is measured as the cost of purchase and the cost of conversion and all the other costs. And there were some specific things that were excluded, such as waste and storage and selling costs. We also talked about the three different cost flow assumptions: specific identification, first in, first out, and average cost. We talked about methods of inventory control. We contrasted periodic and perpetual methods. And then we had that last example about earnings manipulation through overproduction. I hope this gives you some food for thought.
It's all about money, money, money. Ooh, money, money, money. Ooh, yeah. Dollar signs